When you go big and you're looking at trying to build a pure play like a really big gold producer, you give investors better leverage to gold. They don't buy you unless they're bullish on gold. So the bigger you are, the better value proposition you can give investors if you have higher production levels and if you have bigger reserves and resources on your balance sheet.
Now, gold has pulled back from January's record above $5,300 an ounce, but it's still trading near $4,500 as markets try to price Middle East tensions, sticky inflation, and uncertainty over U.S. interest rates. Copper, meanwhile, has remained above $6 a pound amid growing concern about long-term supply shortages and possible new U.S. tariffs on imports. Well, joining me now is mining entrepreneur and Equinox Gold chair, Ross Beaty. Ross, thanks very much indeed for your time.
My pleasure, Devin. Happy to be here.
Yeah, look, it really has been an incredible few weeks and even more shocking couple of months, I would imagine. So a lot happening. I got to just start by asking you, when you wake up in the morning these days, what's the first thing you look at? Is it gold, copper, bond yields, oil, geopolitics? Because it does feel that, all of them are suddenly driving metal markets at the same time.
Devin, I've been in this business a long time. My first public company I began in 1985. So that's 41 long years ago. And I've seen markets come and I've seen them go. Every single day there's something new to talk about, some new event. All the macro events in the world, they're every time is sort of unique in its own way, but quite frankly, we always live in interesting times. And so what's gone on in the last couple of months really isn't any different than it was 6 years ago, 10 years ago, 20 years ago. It's kind of noise in what you would look at in terms of the metal markets as the really long-term trends, because you can't look at any metal on the basis of what happens in a day or a week or a month. It's really long-term trends that drive metal prices, long-term trends that drive demand and supply, which of course factor into metal price. And that's what you have to look at.
Yeah, now that's a very interesting theme because it really is about discipline of the mind when you're looking at all of these factors. Now, gold is still holding near $4,500, Ross, even after Moody's downgraded the U.S.'s sovereign credit outlook and markets began questioning how sustainable America's debt trajectory really is. When you look at this rally, do you think gold is now reacting less to inflation and more to a deeper loss of confidence in governments and fiscal discipline?
For sure. Gold is reacting, number one, it's reacting to the loss of confidence in the U.S. dollar. Yeah. That's it. And gold is benefiting from this because the U.S. dollar has been the world's go-to currency. And in any times of stress and problem and turmoil, people buy the dollar. People buy the U.S. Treasury, typically the 10-year Treasury. That has broken down really ever since the U.S. tried to weaponize the dollar in 2022 when Putin invaded Ukraine. And it's just deteriorated since then. The dire condition of the U.S. Fiscal condition, the amount of debt that the U.S. has, gives people pause as to why they would want to hold U.S. Treasuries. And so what are the alternatives? The euro, the renminbi, the Bolivian peso? I don't think so. So for 5,000 years, people have bought gold as an alternative store of value, an alternative form of money. And that's happening today as much as ever, both by central banks and by individual investors. People are buying gold. That's what's causing the gold price to go up. And that really happened last year in as much as any other time when gold had this glorious run from $3,000 to $5,500. It really was in that period that you saw this amazing trend from so many global investors into gold.
Yeah. I'm wondering what you think about these sort of short-term blips, right? You've got the Strait of Hormuz coming in. That's one news event, and you see a little bit of disruptions in that trajectory. You mentioned a little earlier about you got to see this from a long-term perspective. So Is it noise? I mean, are these war news stories and everything that affects the markets noise as you see it?
Yes, yes, they are noise. We've lived through multiple wars in the last 10 or 15 or 20 years, Iraq and Kuwait and bombings in Iran and obviously Ukraine and other turmoils. So it's typically gold really doesn't have that much of an impact from geopolitical events. It has a much more impact on macroeconomic events, much more long term issues like that. As we talked about, the weakness of the dollar, the prospects for inflation, the outlook for increasing or decreasing indebtedness in global economies. That's really what has driven gold, looking back in my experience, like 40, 50 years. So it just doesn't, this is noise, these geopolitical events, it tends to be noise. It does create some kind of an impact short term, but it's very short term.
Yeah.
And it unwinds. If you want to look at metal prices and across the board, look hard at the supply fundamentals and the long-term demand fundamentals. That's how you take bets that actually persist. Using this short-term noise is no different, quite frankly, than investors looking at just about any company based on kind of quarterly earnings. These days, prices are very volatile because people buy or sell based on quarterly earnings hitting or missing guidance by a few percent. And that's crazy. The long-term investors buy the long-term growth prospects of those companies. And I think that's the much more sensible way to look at metal price movements.
Let's talk about some of those metal prices very quickly. I want to touch on two of them, right? You have media reporting this week that traders have been rushing copper into the United States ahead of possible import tariffs, with the CME-LME price gap widening sharply, right? What do you make of how copper is being played at the moment, Ross?
Yeah, again, it's a short-term thing. That's going to have an impact on prices for the short term, that kind of thing. But copper's run from, say $2 a pound, whatever it was 10 years ago, to $6 a pound today, record highs, persistent despite wobbles in the world economy, persistent despite geopolitical turmoil, is all about demand growth meeting relatively difficult to change supply long term. That's why prices are high. That's why they're going to stay high. They're not going to double or triple from today's levels. That's crazy. Copper is a huge commodity. It's got massive amount of demand and supply in its future, but you cannot change supply quickly. So these prices are going to stay higher for longer. Ultimately, there will be a supply response to high prices. You're going to see more copper production coming on stream in, say, 5 years or 7 years, and you're going to see a little bit less demand, which is going to be choked off as prices get higher and higher. This is classic economics. The price is set at the intersection of demand and supply. So you're not going to have these prices last forever. The world has always been, in metal markets, a cyclical world. There are boom times and there are bust times. This is a natural phenomenon having to do with demand and supply. So you'll see that in copper, you see that in gold and silver and every other metal. But right now, the metal prices are in the sun. They're almost synchronously at near or at record highs. It's a great time to be a metal miner. We just want to enjoy these times forever, but they're not going to last.
Yeah. I want to quickly just turn around and look at silver on that theme. I mean, you described parts of the silver market earlier this year as being frothy or even bubbly, right? At these levels, what is it, $75 an ounce? Do you think silver is still being driven by fundamentals like industrial demand and supply tightness, or has speculation started taking over, Ross?
Sure. I did say that silver was in bubble territory when it hit $120 an ounce in January this year, and it was. It quickly retreated down to $70, $75 an ounce where it is today. Quite frankly, that's still extremely high on if you go back 50 years, or actually if you go back, forever, it's still trading at extremely high levels on any kind of long-term look back. What's driving silver? Silver is being driven by a combination of fundamental in industrial demand, particularly for solar panels, where silver is a fundamental component. It's also being driven by retail and investor speculative demand that, supply will be constrained, that electrification reality will persist in creating longer-term demand for silver at a higher level, and that's going to keep the price higher for longer. The problem with high prices is that it's going to reduce demand because it'll reduce the amount of silver, for example, going into photovoltaic cells. By thrifting, companies will use copper or other technology that reduces the demand for silver. And of course, higher prices, like I said with copper, it's exactly the same. All metals are the same. The higher prices are going to stimulate more supply. You're seeing this with new IPOs on silver companies. My own company, Aluminum Metals, went public in April, and it has a gigantic silver deposit in Poland. It's going to be probably the second largest silver mine in the world when it goes into production. But when is that going to be? Minimum 10 years from now. Minimum. It's going to take years and years and years to get feasibility studies done, get Polish regulatory approval, financing, constructing these mines. They're very big mines. They're going to produce a lot of silver, but it's not going to be for the near term. And that's across the board. Whether you're looking at zinc or copper or silver or gold, it takes a lot longer to build mines these days, to get permits to build mines. And that factors into metal prices across the board. Yeah. But long term, silver is going to go down. I guarantee it.
Yeah, so let's talk about that. I mean, when you sit down, you look at these company ventures, what you're doing with the project you just mentioned, what sort of price do you input on silver, for example, in the future?
Yeah. Well, that's the same with all metals. The reality is we've lived in this kind of weird world where official inflation is low, but real inflation is a lot higher. If you try to build a mine today, you're looking at sort of double the cost of what it would cost 5 or 6 years ago, pre-COVID. So costs have gone up, and that's not only to build a mine, but it's to operate a mine. Fuel prices are higher, labor costs are higher. Typically, things are priced in the U.S. dollar, and as the U.S. dollar strengthens, as the local currency weakens, labor goes down. As the local currency strengthens against the dollar, labor costs go up. So there's a whole pile of costs that are going up right now, and that means that you need higher prices simply to give you the same returns as you might have had 5 years ago with much lower prices. So for sure, we're talking about inflation-adjusted metal prices. Today's $6 a pound for copper, for example, might provide the same economic returns to the same ore body as a $4 price 5 or 6 years ago. Depends on where, of course, in the world, but that's the reality. We've got to look at inflation-adjusted prices because inflation is a real thing, and it's absolutely hammering construction and operating costs in mines around the world right now.
Yeah. So while investors have been watching the gold and silver prices very closely, they've also been watching, Ross, one of the biggest recent moves in the gold mining space, your proposed combination with Orla Mining. Now, the deal would create, $18.5 billion North American-focused gold producer, targeting about 1.1 million ounces this year. Is scale now essential if miners want generalist investors to come back?
Well, we did that transaction because management of both companies and boards of both companies believe in the thesis that bigger is better. In the business, whether you're mining gold or copper or any metal, investors today want large companies. They want scale. What does scale bring you? It brings you diversification, thus lower risk. It brings you a stronger financial condition, thus lower risk. It brings you better liquidity, so shareholders can get in and get out more easily. And therefore, you're being attracted to larger capital pools when you build bigger companies. But more importantly to me, when you go big and you're looking at trying to build a pure play like a really big gold producer, you give investors better leverage to gold. They don't buy you unless they're bullish on gold. So the bigger you are, the better value proposition you can give investors if you have higher production levels and if you have bigger reserves and resources on your balance sheet. It's just a value creating exercise to get bigger. Investors reward this by giving larger gold companies better multiples. That's because they're lower risk. So it's just a value creating proposition to get bigger. And this was what the Orla Equinox deal was all about. It was combining two companies into one, making a bigger enterprise, taking the best of two really solid management teams. And also, as sort of icing on the cake to me, you're creating a Canadian gold mining champion with three large, low-cost, new Canadian mine. Well, two of the three are new Canadian gold producers. So the new Equinox will be the second largest producer of Canadian gold after Agnico Eagle, and that right now commands a premium by itself. So to me, it's just a very solid transaction in terms of its rationale. There are real synergies. Both companies operate in Mexico, the U.S., and Canada. It's going to produce a really cool company, and at the end of the day, internal growth alone should take it to producing almost 2 million ounces of gold a year.
Yeah. Look, mining companies have spent years talking about capital discipline, ESG, and shareholder returns, right? Yet many mining stocks, Ross, still trade at weak multiples compared to the metal prices themselves. Now, has the industry failed to fully rebuild investor trust after the last cycle? What's your take on that?
You know, it's hard to say, to be honest, Evan. I really can't comment too much to that. We just put our head down and try to do the right thing. We don't. Investor demands, they come and they go. One cycle, a certain part of the cycle, investors want you to have capital discipline, no growth, no money. They want to return capital to shareholders. At another time in the cycle, like right now, for example, investors want growth. They say, "Oh, we don't care about shareholder returns quite as much on the dividend and dividend side or share buyback side. We want you to put your money into new projects, make yourself bigger." So you kind of have to, when you're a manager of these companies or when you're on the board, you've got to kind of step back and say, again, you're looking at long-term value creation. This is a long-term game. You cannot be too distracted by the short-term interests of investors who can buy and sell at any moment in time. You cannot do that as a management of the company, or you can't do it as a long-term shareholder like me, where you're actually embedded into the company's board and management. So I kind of take all of these investor so-called demands or investor focuses with a grain of salt. At the end of the day, having been in this game a long time, what is really important is long-term value creation. You've always got to have your eye on that ball, where you're going, not on day-to-day, needs or demands of investors or even mining analysts.
I find that very interesting because, you've spent decades building companies across gold, silver, and copper. Yeah. Which metal do you think the market is misunderstanding the most right now?
I've never ever had to answer that question. I don't know. I could name 50 metals. I could go down the periodic table and go through all these metals that one time or another are in the limelight or in the doghouse. Rare earths, lithium, sodium, helium, so many, not all metals, by the way. But it seems that there's a flavor of the month. And very often the flavor of the month, I just think is ridiculous. Last year, for example, President Trump used to like to obsess critical minerals. And maybe it's not just President Trump, it's a lot of different governments around the world. For example, he talks about rare earths. Well, they're neither rare nor earths, by the way, but they're actually not that, they're not that rare. It so happens that China has dominated the production of those on the refining side. And they've done that because they have cheap power, cheap labor, incredibly supportive government policies, lots and lots of low-cost debt. And China has been this juggernaut of metal production across the board. So all of a sudden, critical minerals are noticed because, too much is maybe in China. Now we have to change our paradigm of developing those supplies externally. It'll come. There's plenty of rare earths around the world. There's lots of most metals around the world, tungsten, you name it. They just have to be developed, and it takes years and years and years to have that happen, and a lot of money And quite frankly, you're going to be producing these metals at higher costs than they probably do in China, which is kind of screwy in terms of classic economics. But that's where we're going. So, what to answer your question simply is rather difficult. You could take each metal and say, just how valid are today's prices. Investors are, they're some of them, especially today, are extremely well informed. That you can do so much rapid research, both with and without using AI, on open source information on the internet. And you can get a pretty good feeling for commodity trends and commodity fundamentals. So investors today just have, I think, a lot more databases than they ever did before and can form more intelligent opinions. So at any point in time, the line about the market is always right is generally true. But of course, there are disconnects from time to time. Things go into fashion and things go out of fashion. Metals really are not unlike shares, stocks. Most are rather well priced, but there's misallocations all the time, and that's what good investors find and exploit.
Yeah. Look, as I wrap up, it's very interesting when you talk about the kind of mindset that an investor has now compared to, let's say, 40, 50 years ago. But just to wrap up, Ross, against that backdrop, you click online and some of these social media pages and you see a whole lot of experts calling out what silver's going to do in the next couple of months, couple of years, gold, and you get these figures bombarded on you. What do you make about that kind of prediction, and how do you follow these multiple sort of expectations that you normally see?
I just ignore them. I've ignored them all my life. I have tried to form my own opinions. I'm not on any social media personally. I don't have Facebook, LinkedIn, nothing. I do my own research. I travel all over the world. I'm a great student of history and geography. I try to look at long-term trends. I try to step back and look at the forest, not at the trees. I don't get polluted by mostly ignorant opinions of people online who are pundits. I tend to discount most of those guys, mostly guys, by the way. I just don't listen to them. I put my head down. I form a thesis. This mining business is a tough, risky business to begin with. And you just have to take a view on metal prices and try to build value. It's easier said than done, but if it's done well, it creates a huge amount of value. And I've been lucky enough in my life to come into many of these metals, like silver. In 1994, we got into silver with Pan American Silver at $5 silver.
Yep.
Obviously, it's had a great run. Well, how do you position yourself for making money in that context? You load up with silver deposits, you load up with silver resources, and you try to have as much silver production as you can. The same exact thing with gold. We started Equinox Gold in 2018 or late 17, just at the start of a glorious run from 1350 to where it is today. I mean, if you build a company that has real assets in that wonderful run, you're going to make a ton of money for people. Equinox began at zero when we started at the beginning of 2018, and it's worth, I don't know what it's worth today, 15 or 16 billion Canadian. That's pretty good wealth creation in just 8 years. So, I mean, we did the same in copper. I've done the same in nickel, in uranium. It sounds easy. Maybe not so easy, but it's not so hard either if you just keep your head down and try not to get distracted by all the noise that's out there, particularly the noise on social media, often written by, people who are less well informed, put it that way.
Well, look, compelling and inspirational. Ross Beaty, it really has been a pleasure. Thanks very much indeed for those insights.
My pleasure. You can probably tell I have strong opinions on a few things, and people don't call them opinions, they call them rants. But just don't get me going. I've got a whole bunch more.
Rants or not, we'll be sure to speak to you again, Ross. Thanks very much indeed.
Thank you very much.